Thank you so much,
You're a
Sanjiv.
amazing human being and an amazing stock picker.
Always a total
Because I think,
pleasure and
your
delight.
concept. Hi, welcome to the next edition of FINtastic Talks. And let me start by apologizing for starting a little bit later today because of a technical glitch. As they say, wherever there is a technology, there is a glitch and there is a possibility of glitch. So, our sincere apologies for the same. And I'm very excited to have a very different version of FINtastic Talks in front of you today. Generally, we have people that a lot of us have met or a lot of us have heard very very often, and but today we have a person who's fantastic, but personally we have not have heard his views that often. So I'm very pleased to present to you the leader of Navi AMC, which is one of the new babies of the mutual fund industry. And he comes in from an IIM Bangalore background and a very innovative and exciting person who spent a long part of his career with Templeton. And since we are already late, without further ado, I would really like to welcome in to join the talk today.
Hi, Sanjiv. Thank you for having me on.
No, Hari, it's a pleasure to have you. And it's a pleasure to have you in this new role. So just tell us a little bit about, as I was talking to the people, we are generally used to listening to the old names, HDFC, Templeton, and Nippon, and ICICI, Pro AMC, etc., etc. Navi is a new kid on the street. So why don't you tell the people a little bit about Navi, what has the journey been, and then probably we jump into your own personal journey from there.
Sure. So Navi AMC is a part of the Navi Group. At Navi Group, we are building something which is customer-centric and technology first. And these are reflected in all our products, which are simple, affordable, and accessible. That's what we believe in. That's what the group is trying to do across its three businesses, which are in personal finance, personal lending rather, general insurance, and the AMC. The AMC itself is about a year in its current role, and we have in this period focused on passive funds. So we have launched 6 index funds so far, of which 4 of them are domestic focused, and 2 of them, which are open for subscription, are international focused, US based funds as well. So that's what we've done so far. Six funds, and in the last year, it's been a period of a lot of growth, a lot of getting our word out there, getting to know more people in the ecosystem, getting more people in the ecosystem to really know the Navi story. And we are looking forward to this. This is just the start, a long, long way to go.
Oh, that's super, Hari. So, Hari, tell us a little bit about your own journey, about your childhood, about your parents, about your education. How did you end up reaching this place? And did you imagine that one day you'll be sitting here as a CEO of a mutual fund and talking to all of us?
So surely not, I would think. So mine's a bit of an atypical story in the finance side. At least it's not like I thought from the start that I will be in a mutual fund or I will be in the finance industry even. So I grew up in Pune and Bangalore. And Bangalore, so for me, it's a return to Bangalore in a sense. Navi Group is based out of Bangalore. That's another unusual part about the group and the AMC itself. Not it's based, maybe the only mutual fund currently based out of Bangalore that way. So Bangalore is a place which is very familiar to me. I've grown up here, but for me it was the usual engineering route, and then you figure out what you want to do after you reach your engineering. For some time, I thought I wanted to do some more engineering, some hardcore, get into masters and do that kind of technical work. But then an MBA, I got into IIM Bangalore, and that started a different story. But it was not that in there as well. I felt that this is finance is what I want to do. So there as well, I took a number of courses. I found out what everything was about, and then eventually I joined an oil and gas company. So that was a very different. That was a different trajectory altogether. But when I was there, I realized that what I really wanted to do was, understanding companies, researching, deep diving into the economy, understanding how everything just comes together in the finance. Right, everything is related. No company operates in a vacuum. It's all linked with everything that's happening in the world. So putting those pieces together was what really appealed to me. So that's how I got into. That's why I applied to Franklin Templeton and started my career as a buy-side analyst. And from there, I moved on to being a fund manager there, and I was looking at their mid and small cap funds, which itself is an exciting space to be in, right? I think each company is so unique. Each company has its own business models. There are no generalizations really in mid and small cap companies. So that was an exciting period as well. And now I've moved to Navi with this new challenge. As you said, it's the baby among all the mutual funds, and we are looking at really scaling it up from here. It's a different model which we are taking up, and we believe that passives are at a stage where the time has come. So we would like to grow along with the industry and grow the industry as well.
That's superb, Hari. So it's a AMC with a difference. And I would love to start by asking you questions about your small cap and mid cap background, because
Sure.
that's a very basic financial planner advisor learns that small caps will give you more return, mid caps will give you slightly lesser, and large caps will give you lesser returns. And this is the typical advice that look, you put your X portion of money in small cap, mid caps, large caps, and but I find it very actually it's not true, but in the sense
Hmm.
that they are large companies in small cap also, because that sector is not large, and they are
Absolutely.
large companies in mid cap also. And
Absolutely.
also, and we also always want to do this spotting, where
Hmm.
we want to find the next generation of winners. And everybody's heard the story of Kotak and how people invested in Kotak Bank when it was young, or how people invested in Infosys. So how do so just tell us, explain to us a little bit more about the small cap, mid cap. What kind of stocks are there? What is the kind of risk, and what is the sort of a risk return ratio there? And that if we want to spot the next winner, or the spot
Hmm.
the next stock which is going to give us a 20x return or a 30x return, then
Hmm.
there is still an opportunity of that happening in a small cap space. Because today it's very difficult for a company to list, and when
Hmm.
even when
True.
listing, they're listing at a peak value, where the juice has already been taken out by the private investors. So is there any juice left in those companies for the clients?
I'll just start off with the first point, on where small and mid caps figure in compared to the large cap, and how it can figure in the entire portfolio allocation itself, and how the risk reward, that the trade off plays off. So now we are taught that higher risk means higher reward, right? I think that's the typical straight line is what you draw, saying that higher risk means higher reward. But actually, the band of reward is much wider. So what I'd say is that lower risk means less volatility around returns, and higher risk means higher volatility around the return. So you've got lower risk here, and less volatility, so you're more certain about what the return is going to be. But small caps are here, where there's a large volatility in how much you're likely to earn in any period of time. So you have got to be able to stomach this churn, this volatility which is happening as an overall sector, as an overall category of stocks, small caps, and at an individual stock level as well. So the whole thing about small caps is that they are very uh, they're like small ships in the sea, right? So uh, the even a slight amount of waves are likely to capsize them, could capsize them. So you have to find the ships which are resilient. You have to find the ships which have got the underpinnings, which will ensure that if there's a bit of turbulence, also they are able to ride that out. The elements of that, the elements of the stocks which ensure that that will happen, it starts off always in a small cap with the management. You have to gauge the management and assess them to understand where have they come from, what is their acumen in the entire in that entire business, their passion for it, their entire will to create a large business, their shareholder friendliness. Do they understand and have they created return on capital which is much in excess of the cost of capital, is, and are they prudently then deploying that back into growth opportunities to create that cycle? I think, and then is the industry large enough to absorb their ambitions in a sense? So I think these are the elements which then put together a small cap stock which can withstand the turbulence. Despite all of this, you will still have the small cap. In the bad time, it can correct. It can correct sharply 50%. What will give you conviction in those times is that these underpinnings are strong. If you have a stock which are able to meet these criteria of a strong management, strong return on capital, ability to grow the opportunity as well, and being able to deploy that capital efficiently, I think that's when you end up being confident that when you have those sharp corrections, you're able to add on to them as well. So I think that's what sets the base for picking a small cap. Are there opportunities today? There are always opportunities. And in fact, I would argue that compared to large cap and mid caps, which are large caps particularly, and to some extent now what the mid caps, the way it is defined by SEBI categorization itself, those are the larger mid caps are very well researched, very well researched. Your ability to find a new way of thinking about those stocks is very tough, and you need to be deeply contrarian there. You might be able to make money then, but then also there's a lot of views which are happening. But in the small and micro cap, I would argue that that is still a relatively under research space. Many of the business models are a developing, b, even if you do the research, very often you can create an insight which is definitely not yet fully appreciated by the market as well. So I think even in the current 250 2000 stocks, and maybe even slightly beyond that, there are many stocks which today we are sitting on, but could be the Kotak banks of tomorrow or the HDFC banks of tomorrow, which have scaled tremendously over the next, which can scale tremendously over the next decade. Every decade you look back in history, you have always had some of these. I think the coming decade is no different, but finding them is a challenge, but they're definitely out there. If you've got the passion, if you've got the screening, then I think you can delve deep into some of these and identify them.
Yeah, but I seriously, I personally believe that we have to, actually activate the IPO market, especially for the
Hmm.
smaller companies.
Right.
Companies are entering the market at too high valuation and too later a stage, whereas
Hmm.
IPO market always used to be high return, high risk sort of a
Hmm.
market, which is no longer. Yes, you have to be very careful because there are a lot of wrong people who came in, got away with a lot of money. But what
Hmm.
has happened is that even right now, look at the tech stocks; they have hardly given any return, and most of the losses have been in the hand of the consumers, whether directly or through institutions. So at the end of the day, it's the retail investors who have paid for those losses. Uh,
True.
so that's a very, but I really like your perspective on the way you explained small caps and mid cap. The small caps, the volatility is higher. And when you were talking about the volatility, it was also telling me of an opportunity that these are
Hmm.
probably better places to do a sip in. Because if there is a volatility, there is a higher return to be
Absolutely.
made via a systematic investment plan. And maybe guys,
Absolutely.
that can be a takeaway from you for you guys, as he said that the large caps and the blue chips are relatively stable and they're growing on a X trajectory, whereas these are the small caps and the mid caps which have very high volatility. So there may be an opportunity for you to do sips there, and maybe sips are a better way of taking advantage of this. So we have a very regular viewer called Ashok Kumar Hari. He's asking a question, and it's a
Sure.
quite a sharp question. He's saying, "Do you see small and mid cap do another 30% after last year?"
Unfortunately, in small and mid caps, they don't go up linearly like that. So I think Mr. Ashok Kumar, for me at least, I think that it's a bit hard to replicate that kind of a performance year after year after year. Um, but actually, the way you should look at them is to look at 3 year, 5 year numbers, because as we said, these are moving in cycles. They are not going straight up. So you could be at this point of it, and it could be coming down. But I think that it's the straight answer for me at least. It's a bit difficult to repeat a 30% year on year. But I mean, in the longer term, if you look at it, I think even if you buy at current levels, even if you buy at if you say FI17 levels, mid caps have moved up much higher than those levels. If you even if you had bought at the peak of last time, you would still be higher than where they were last time at the peak. So I think uh, the markets keep on moving up relentlessly. As Sanjiv has said here, I think the approach has got to be that when things are looking pessimistic, you've got to be looking a bit more optimistically at the market. You have got to be deploying a lot more actively at some of those points. And I think that's the approach which one should take. So, chasing recent performance is a bit tricky that way, particularly in small and mid caps space.
Yeah, guys, Hari had answered it very well that there is mid small caps means high volatility. So if I go simply by the principle of high volatility, that means if it 1 year it is 30%, then next year most likely it's going to be negative. But see, at the end
Possibly.
of the day, so this is a very basic hypothesis because they
Yeah.
can be 2 3 years of very high positives also. I remember a fund I picked up in small cap. I put in an X amount of money. When I was looking at the returns because of this after the pandemic, it had delivered me more than 100% return. So
Mhm.
that's not, I can't expect a fund to do that every year. It's not possible at all. So point is that eventually it'll the returns will average out. So you have to be careful of that, and you have to understand that these funds will have some amount of volatility, and that's but they are very important part of your portfolio because they are one helping you diversify your portfolio, and other is that they are helping you pick out some companies where there is something special happening that may not already be known in the market. So this is the takeaway I have, that look, have small cap and mid caps as a percentage of your portfolio, and it's better to do it via SIP route. And if you choose a good fund manager, he may be able to help you find some winners in the long run. That and it's because here, Hari, I know you guys are focused more on passive funds, but here I think the role of an active manager is very very important in this category. So also,
So, so if I may just add to that, a couple of points which I'd just like to add on that is that I think, as you said, small caps, if you've done the asset allocation and small caps are X percentage, when that period of outperformance happens, your allocation is automatically moved up. So you can afford to allocate a bit less than I think in the next year. So I think that's another way to maybe think about that. But and just adding to the point on small caps, we agree. I think that is a point where the active fund manager still generates alpha. They still generate the extra return, and there is definitely a role for in the small cap space, at least for an active fund manager. I have as much as um, we believe in passive. We also recognize where active still works in the markets, and that definitely is what we would like to say on small caps itself.
and there is another very regular viewer, Rishi. He's asking this question, which is again a very sharp question. So Hari, he's saying with the focus of on passive funds, okay, then how are you going to create that alpha in the market? How are you going to prove yourself to be
Mhm.
different than other AMCs? So what do you say, Hari?
So I think from a personal portfolio allocation, I think what's important is that average is not a bad place to be, because because 80% of large cap funds have failed to beat this average in the last 3 to 5 years, particularly in the large cap space. Increasingly, we are seeing that even in mid caps, some of this is happening. There's been a struggle to beat this average. So average is not it has not been a bad place to be in if you're looking at creating a portfolio for the long term. So I'm just saying that, and second thing is that performance also comes in cycles. Performance comes and goes in cycles. So when you are picking the fund managers as well, there is there is a selection problem as well, as you can figure out. Uh, I think the other thing is that there are still some places, as we said, that in small caps you will definitely have parts of the market where there is a role for the active fund manager, but in many parts of the entire market itself, the funds are not beating the average. So I think when you are looking to plan your long term horizon, you should be looking at including a fair share of passives in it. So that's where we are looking at in terms of how are we different. We are, as I said at the beginning, Navi, we are looking at building something which is customer centric and technology first. These are products which have a focus on low cost. That's how it translates into passive for us. Low cost and quality in terms of meeting the requirements of tracking the benchmark itself. So I think that's where we are looking at in terms of at least a basic index funds for now. Beyond this, we will definitely look at passive funds, which are a bit more complex, a bit slightly next level, maybe let's call it, where there will be a different requirements and different kind of return profiles as well. So that's the approach which we are taking towards growing this business itself. And yes, I think so. That's the approach which we are looking at in terms of growing the business.
So, Hari, again, a very similar question by another very regular viewer, Madhusudan. He's
Mhm.
asking about the USP. A similar question that with so many AMCs, so much track records, people just index funds being available from others also. How is Navi going to be establish itself as a USP when he's saying there's in a separate question, he's saying that even technology wise, everybody's catching up. Even the older AMCs are getting very technology savvy, and things which were not happening earlier are today happening. So how does Navi create a USP in this market?
No, we agree. I think at least on the index fund side, what we would say is that it's also true that not everybody is focused as much as we are on passives. So right now there is most of the fund houses would be more focused on the active side, while we are looking at creating this entire business grounds up from a with a view on being in the passive side. So that itself gives us a place which we are starting off, which is very different, and we have a chance to create a organization and products therefore which are directly not at a cost structure itself which is far lower than what we are looking to than what maybe others would be able to do. So I think our approach is being low cost, and that should be sustainable for us. We would not look to uh, we look to make that a sustainable business proposition, and we look to create passive funds which will deliver consistent returns for the customer as well. So I think that's what we want to be. The way we think about it is this, right? So if you have index funds, they're commodities, and if they are commodities, then they should be priced as such, and that is what we look to price our funds at. We believe that if you're looking at passive funds itself, then you should not need to look any further than us. Right? We want to be that default one stop for the passive funds.
And Hari, so now let's move to a sort of a different topic. So just that with the recent financial crisis all over the world, what is happening in US? So a
Hmm.
lot of our viewers want to understand what is happening in US, what will be the impact. There's another very regular viewer, Pandi, is asking this question that look, what is exactly happening in US and what will be the impact?
Right, that's a very relevant and topical question. So I think in US, so what's real? It's a very, very confusing situation, to be honest, because on one hand, if you look at it, you have this situation where the US consumer has deleveraged his balance sheet. He's sitting on a lot of cash, which has been doled out to him by the government. So he is personally very secure, and he has come from a period of very, very low interest rates as well. Corporates there as well, very deleveraged. So it's a very healthy situation on that side as well. But at the same time, you have this situation which is where all of this has led to sky high inflation. And in response to that sky high inflation, the central bank there is tightening. They are looking to raise the interest rates. And when that happens, typically what tends to happen is that there will be a bit of a jitter in the market. Um, what was unforeseen was this entire Ukraine situation which has happened. And if supply chains were tight earlier because of COVID, what Ukraine has done has added like more fuel onto that fire. So it has reached a situation where we are unable right now to figure out how much of this is because demand isn't there, how much of it is because supply isn't there. Many of the so even in India today, you go and try to buy a car, they'll tell you to come back in 6 weeks, maybe, right? I mean, at least at the even the most basic variant, they'll say come back. Others will come and say come back after 6 months. I mean, that's a situation which we are in. So as a consumer, you may just say that I don't even want to buy a car right now if this is what I'm going to have to deal with. So, but that doesn't mean that you don't want to buy a car. A similar situation is playing out there as well, where there is supply chain bottlenecks. There are shop. I mean, personally, some people who have come from US and some of my relatives have told me that I wanted to buy a variant of say something for you to have at home, but it was just not available on the shelves itself. It's so I could not buy it. So there's that situation as well, which is happening. So all of this has led to a situation where demand supply is confused, I think. But the net impact is bad on the economy because the economy will slow down. It's choked. What the Fed is saying right now is that I don't want demand to go up as well. So let me bring down demand to a situation to a point where it can match the supply, and then the supply can grow. So that's what I think is happening in the US. So in the process of bringing down demand, you are seeing what they are talking about as a recession coming into play. That's a fall in the economic activity. So if that is a situation, then you will have a situation where where there will be a recession. The Fed may actually induce or create a recession just to ensure that this inflation mess is sorted out. That's the situation we are in right now. But does that mean that there is large? Uh, 2008 was very different because you had a financial crisis. This is a very different situation where the Fed is trying to reduce the demand to meet the supply in a sense. And so I think we can once this plays out, if inflation is brought under control, the first signs of that, and you'll start seeing a pickup again in the economic activity.
No, that's superb. So, as they say, Hari, in every dark cloud, there is a silver lining. In every crisis, there's an opportunity. So, investors, what is the opportunity in what is happening? So, with your own money, what would you do? How would you create an opportunity in this adversity?
Oh, I think this is an opportunity for sure, and that's what I would do with my money, add into the U.S. market. But I would look at a mix. I would look at a broad-based index in terms of buying into. I would look to diversify my risks and create a portfolio where add into a portfolio which will give me a play on a recovery of the overall U.S. economy. I think. Right now, at least, the U.S. economy has been something which has still been an innovation, an engine of innovation in the world. And over the next decade, it'll look nothing like what it was 10 years back. So I think that's what we should be playing for. I mean, 10 years back, 4G wasn't really there, right? I think, and if you think back to what it was 10 years back, very, very different world. I think that next 10 years will again be very, very different. In this world, you will end up seeing new players come out. You'll end up seeing new countries emerging. You'll end up seeing new economies, new engines of growth happening. India is definitely a core part of any of our portfolios. But you have to be looking beyond the Indian borders as well. You have to diversify a portfolio to where there could be the next leg of innovation as well. And currently, at least, US still fits that bill.
Yeah. So, talking about international investing, and I'm personally very excited, to be investing in the international market. I think some of the companies are strong. The valuation is become much more attractive, and I would like to get into them. But today, with that ban on
Mhm.
international funds, that's actually creating it very difficult. So, just tell us, our viewers, a little bit about that. What has happened? And I'm sure with two international funds in your kitty, you would be very much, your company would be interacting to what is going to be the solution to that.
Right. First, at the outset, I'd like to say that we have two international funds: the Navi US Total Stock Market Fund of Fund and the Nasdaq 100 Fund. Both are open for subscription today, and that is because we are in a different quota for the entire industry, which is investing into ETFs. Now that has a ceiling of about $1 billion, and the rest of it was about $7 billion. That $7 billion limit has been breached, but the quota in which we fall into is still got headroom, and that's why our funds are still open for subscription. See, I think I can't necessarily, I can't forecast when this will eventually play out. Me and the entire industry, of course, is hopeful for a reconciliation or a resolution of this, but it's hard to forecast when this will resolve itself. I mean, I think the yeah. So I think it's a bit hard to estimate, but I think I'm sure that RBI, SEBI, they'll do the right thing, which is required, I think, for the industry and investors and the economy as a whole.
So, Haris, some of our viewers are asking a bit more information on these funds. So,
Sure.
how is your the people are asking? Motilal Oswal also had a Nasdaq index fund, and
Yes.
where you can't put in fresh money, but whereas you're saying that you're in the ETF quota. What
Yes.
exactly is your fund? How is it structured different from the other funds? And what are the charges?
Right. So we invest into an ETF which is based out of US, while some of the other competition were replicating or were investing into stocks internationally. If you were investing into stocks directly internationally, then that limit has been breached. Since we are investing into an ETF, if an investor gives us funds to invest into the fund, we will take it and invest it into the ETF which is listed in US. So we invest into what is Invesco's Triple QM product. And that is a product which has got a low expense ratio. It's got a it's a lowest cost in the entire industry today. And I think the tracking difference also, which has been an issue for investing in international markets, is very low. We've had a very good experience on investing in that, in terms of mirroring the returns which the Nasdaq itself is generating. So that's the reason why we are able to still be open, since we are investing into the ETF there.
Okay, and what's the difference between both your funds, like the Nasdaq 100 and the other US fund that you have?
So the Nasdaq 100 invests into the Nasdaq. I think that's been a very popular index for investing from India. I think that's very well known. The other one invests into what is called Vanguard US Total Stock Market. Now that ETF is actually US's largest fund family. $1.4 trillion in size. That's the size of that Vanguard ETF and its associated funds, the Vanguard US Total Stock Market Fund. So it was not available to investors sitting in India before this. So Navi has bought this particular product for the Indian investors, and it's available at a very low cost as well. So the fund charges 3.03%, and we charge another 0.06%, so a total cost of 0.09%, which is by far the lowest which is there for international investing. What this does is that it gives you access to 4,100 stocks, And it's become almost a default as a result for many investors who just want to invest in the US market. It has got about 80% investment into S&P 500 as an exposure, but it also has investment into small and mid cap, which is what S&P 500 doesn't offer. The S&P 500 as such is basically a large cap index for the US markets, while the Vanguard ETF has an exposure to small and mid cap as well. So that's what it gives you. It's a one stop. We see it as like a one stop investment into the US total market.
Okay, so again, some very interesting questions, very very sharp questions. So, just if I was to summarize some of these questions, the question is, Hari, they're saying that look, India market seems to have a higher opportunity than the global markets. But where should our money be in the Indian market? Should it be right now? Would you keep your money more in a large cap? Would you keep it in a flexi cap? How would you manage your own money if you were to make a change to your money? How would you reposition it in this market?
See, honestly, direct answer is right now I would be looking more at large caps, given where the current market state is, and as you said, given that the smaller mid caps have run up as sharply as they did over the last 1 and 2 years, this is a place where I would look at it. We are as well going through a period of volatility in the markets, and so you will end up you will end up seeing that you will have to deal with that period of volatility. Now, if the markets correct more, then it gives you opportunities to add more to the small and mid cap. But at least right now, I would say that the risk reward is more toward the large cap. See, this though is a very short. I'm giving a very short termish answer because this is the 1 to 2 year kind of an outlook. But in the longer term, I would say that it's got to be an asset allocation game. Really, I think you've got to have a mix of all the large, mid, and small in your entire portfolio, plus international as well. I would say that I think in the last decade you would have missed out if you had not invested in many of the emerging trends. And today you do have the ability to invest in some of the international markets as well. So I think that is definitely a part which you should be having in your portfolio as well.
And there are a lot of questions on the the RBI governor, whether he's likely to increase the repo rates and the rates further. And there
Hmm.
seems to be a strong belief between the viewers that these rates are going to increase. So people are asking what is going to be the impact on the debt market? What can they do to be careful in this situation and that we are in?
Yes, I think that is a consistent. I think Mr. Das came on just yesterday itself, I think it was, and he did say that as well. He said that he's going to. He made very clear that that's what he's going to do. He's going to be raising the interest rates. So he's removed the uncertainty around that at least. See, I think if I look at what's happened historically over again longer term periods, we have basically the 10 year has moved between about 6% at the lower end to 9%. 9% was maybe when we were at in 2012, 2013. So that's been the kind of broad range which the 10 year has moved around in. Today we are at about 7.4. So which means that we are somewhere in the middle of that entire range. Now we don't know whether it's going to be as bad as getting back to 9% completely. But I think that we have reached a point where some of this, we are clearly off the bottoms and we are somewhere middle of the interest rate increasing cycle in that sense. Some of this is part dependent. If inflation stays high, then RBI governor will have to be aggressive. But reminder is that even in 2012, 2013, the inflation has reached 12, 13%. So even when the inflation was at those levels, the 10 year had reached 9%. So I think we're somewhere in the middle of the interest rate increasing cycle. I think we should expect interest rates to move up a bit more, but also be mindful that this is not always going to just keep on going up.
But the point is that again, this is again my personal view and a lot of views here. The inflation right now is not truly due to increase in demand. It's due to scarcity in supply. So
Yes.
if you increase the interest rates, you're actually increasing the inflation rather than reducing the inflation. So how will these increasing these interest rates truly reduce the inflation? So this inflation truly is not dependent on consumption. And also the second question which some of our viewers are asking, that India is, like if you talk about Davos, what's been saying that world manufacturing will move to India, and that whole manufacturing story is around low interest rates. So aren't they playing a very dangerous game that when you have an opportunity and they're letting go of that opportunity by increasing the interest rates?
Yes, I think some of that has been now addressed in terms of the policy measure which was taken a few days back as well. And when you're looking, when the cut in the fuel prices, for example, was announced, right? I think the reduction in excise duties, it was basically with this in mind that some of this is being caused by crude oil coming in, but we can address inflation by cutting the duties. So that itself is another way to control the inflation as well. So a combination of these measures is definitely required. What I think what tends to happen is that there's been a lot of pressure on the rupee as well. The external front tends to see a lot of pressure. So the RBI has seen an outflow of how much has it been, maybe $40 billion over a period of 2.5 months, which is very, very sharp. We have $600 billion still, but that pace of loss of forex reserves is quite sharp. And in response to that as well, to prevent, and that itself, if we let that go completely, then that ends up with the rupee depreciating sharply, which will mean that it will add further to the fuel of more and more inflation. So I think with response to that, we needed to raise the interest rates as well, respond to some of that. But you're right. I think the opportunity for us is definitely in manufacturing. So I think that whichever I felt that the interest rates have gone up a bit, they may not go up in perpetuity. But I also don't think the manufacturing story gets derailed by 100 bips increase in the interest rates. It's not like the opportunity is that sensitive. This is the opportunity which is truly huge in magnitude, and the incentives, the pricing, etc., which is there. I doubt it swings so sharply at that margin. So that would be so that's why I'd still be very optimistic on the overall opportunity or the what is being created, the framework which is being created by the government, and the ability of the Indian entrepreneur to take advantage of that opportunity which is presented to him or her.
Hari, there's another question, which is again a very, very sharp question. So
Sure.
I will not speak in the name of the thing because there's good part to the question and some parts which I think are slightly, not to be discussed here. So there's a person is asking a question. He says his expectation from Navi AMC were phenomenal, and he was saying like I wanted you to be bringing cutting edge tech passive funds to us to India, something like Cathy Woods and others, something very innovative passive funds. But you have brought us the most uninnovative funds, let me say. So they're saying that this is not what I expected from Navi and my expectation. So can people be looking at cutting edge ETFs being brought to India through you guys rather than just these run of mills funds which have been brought over? And what is the timeline for the same?
Oh, I love that question. So let me just explain that. Gives me a chance to explain why we launch certain products and what's there out there going forward. So we believe that the products which we have launched so far form the core of a portfolio. Right? So we got the Nifty 50, Next 50, and Midcap 150, which any portfolio should be having. I mean, it's like the bedrock of a portfolio. We have also launched a bank index fund, which is again an evergreen kind of a sector. The two products which we launched in US also were again products which have become very popular, which are again the US total stock market is a product which should just be a core of a portfolio. You keep it there, and you just that's just formed a part of your long-term portfolio. that's where we were, and that's what we launched in just Jan to March. There is a ban on NFOs, unfortunately, but if that were not there, the next products would have been a lot more innovative. And I would just say you can look at what we have filed with SEBI. That's you can go to the website and see what all we have filed. And it's there are some innovative ones there as well. I can promise that some of them will be innovative going forward as well, and we will look at introducing some interesting products. And I would love to have your support when we do launch some of these products.
Yeah. So, no, no, but that was a quite an interesting question, guys.
Absolutely, I
Uh,
liked it.
so there's also a very interesting question by Rafi Tagala, and he's asking a very generic question. For an economy to grow, there has to be a fall in economy either due to geopolitical issues or a world war. Or so does basically, let me simplify it. Does a war result in a boom later? So here my personal view is that, let's not say world war, but whenever there is a war,
Hmm.
there is a boom, especially in the western economies, because those economies are based on weapon exports. Like US is giving more than 40-50 billion dollars of weapons to Ukraine, but at the end of the day it's giving a $50 billion of business to its arms industry, which is eventually going to create a lot of business in the economy. And whether Ukraine is able to pay for them or not, but the US taxpayers will definitely pay for them. So at the end of the day, it's going to come from their pockets. So whenever there is a war, and we saw it in Europe after the World War or any major war, that if the economy survives, there is a strong government,
Hmm.
then there is a boom. So would you like to add anything there, Hari?
Yeah, sure. Firstly, pray that it never becomes a world war. I think the amount of hardship which you'd have to go through to get that boom is definitely not worth it. It's just too much hardship and pain and suffering, and for all of us. So I think wars are a time which are very tricky to invest. But you're right that at least the example of World War II was that there was a massive boom after it. See, I think we have. I'm just going to divert a bit to that question in a sense and give an analogy. In a sense, we have already been through a world war, which is COVID. That was a war which was waged by a very silent killer, but in the end, all of us faced a lot of the effects. And bear me with the analogy here. In the World War II, what happened is that similar situations happened that if you want, the supply chains were severely disrupted. So all the supply chain was diverted towards building of arms. And if you wanted to buy a TV in US, for example, in the World War II, you could not buy it because it was not available. Similarly, in COVID as well, if you wanted to buy anything almost, you struggled. You struggled. Supply chains were severely impacted, and everything went towards. I mean, everything was just shut down, right? Everything went towards battling this silent killer which we had. And today I think a million people have died. More than a million people, millions of people have died due to COVID. So I think that has also we have already been through something resembling a world war in that sense. I think, and we are coming out of that, which is why I feel that we are in a situation right now where demand may be suppressed, and you are seeing the effects of a choked supply chain, which is impacting us and having an impact on the inflation. The coming years, as you said, India in manufacturing will play a role in declogging the supply chain as suppliers, global suppliers, start looking for alternatives in terms of growing the economy, in terms of growing their supply chains, and where resilience will become more important than just pure efficiency. You will start looking at India as a partner for building some of this resilience in the supply chain, and supply chains will start routing through India as well. So I think um, we are seeing the rebuilding process for one world war, which has just been just played out in front of our eyes.
Yeah. And there's another interesting but very basic question from Pandi. Pandi is asking, he wants to make a 5 crore corpus. And he's saying, how much would I need to invest to be able to create this corpus of, in the next 10 to 15 years? So I will let, Hari answer on the product, but let me just simply tell you, देखो, there's a very basic rule called 15, 15, 15. So that means for if you invest 15,000 rupees for 15 years and you're lucky enough to get a 15% average return, then you make 1 crore. Okay, so Pandi, if you want to make 5 crores, then that is simply 75,000 rupees. 75,000 rupees for 15 years, giving you 15% return. You should be able to make, 5 crore rupees, and that your corpus. And also remember that returns are a dance between risk and return. Okay, so whenever you want higher returns, you have to take a higher risk. But 15 years is a good scenario. And let me tell you, like even Bajaj Capital, probably, today there are so many wealth management houses out there. But today we have helped maybe the maximum number of retail investors become crorepatis or people with a crore rupees by doing systematic SIPs. And SIPs was something a lot of people, I don't know whether you know, Hari, was innovated by Bajaj Capital in 1970s. Even before mutual funds came into place in India, that we used to offer these SIPs where we would help people buy these blue chip stocks. So it
Wow.
was like, where the people would buy these outlots, one shares of bonds, Hindustan Levers, and the companies that used to do well. So we would make a bucket of blue chip companies, and people would buy one share every month. And that was how the SIP, when we used to have this campaign called "Make Your Children Lakpati," people
Wow.
didn't become Lakpati. Most of them became Crorepati because India grew so well. So point is that this is so it's very simple to do, guys. If you want to make 5 crores in 15 years, simply start doing a SIP. So I will let Hari answer which product should you choose. I will let Hari answer, then I'll add my own 2 bits to that.
No, I think that and
Hari,
Sanjiv,
which
you're so Sanjeev, I think that is this is definitely a lot more your domain than mine. But I would just, I mean, time horizon, risk preferences. These are definitely key to deciding the kind of products. But I think it's got to be well diversified, and I think that's the key towards it, towards building a portfolio for the long term. But I'd defer to you on some of
yeah.
that as well.
Yeah. So simply, I'll say that, look, guys, if you want to do that, one, please keep an advisor with you. You must have an advisor because he is your guiding hand. And please understand, if you pay peanuts, you'll get monkeys. And at the end of the day, even if you're paying point 0.6, point 0.7 is the cost of an advisor, even on a 10 lakh rupee portfolio, you're not paying anything major over the year. But you need an honest, good advisor from a good company who's going to give you honest advice, helping you select the right funds. Because it's very easy, catcher, tell me which funds to invest. What are the funds to invest? What are the funds to invest? What are the funds to invest? So simply tell me which funds to invest. And then I will tell you which funds to invest. And then I will tell you which funds to invest. And then I will tell you which funds to invest. And then I will tell you which funds to invest. And then I will tell you which funds to invest. So first product you choose is a flexi cap. So where the fund manager is doing the choice between small cap, mid cap, and large cap, and he's doing the portfolio restructuring depending on the market situation. So I am personally very bullish on flexi caps because I think they are very, very good. If you want to be slightly more conservative, then even balance advantage funds are good, but they will not give you a 15% return. So there you'll have to increase the amount of money that you're. But if you want to take a lesser fund, but their portfolio rebalancing is happening between debt and equity, which is actually what is called profit booking. Okay, so where the fund manager is automatically moving money from equity into debt to maintain his ratio, or from debt into equity, depending on the market situation. So they end up giving a very, very decent and good return. But which fund to be in must have an advisor from a good company with a good research background, and it will make a lot of difference for you to do it. And is it possible to do it? Yes, it is very much possible to do it. It is very easy. All you have to do is stop waiting on the sidelines and start running the race. There's a very old quote that if you don't run the race, then you have already lost at the beginning. But when you run a race, but you lose, even if you lose like a winner. And there's a lot of possibility here. You don't have to be the first in the race, but you just have to complete the race. So you will still be a winner. So there is a great opportunity out there. And also there's a lot of questions on careers where people want to come and work. So on a wealth management side, I can tell you, look, guys, we are always happy. Today, wealth management, our problem is the number of people. 92% of my customer complaints is that my Bajaj Capital is not interacting with me enough. I want to I want to more person to connect with me more. So for us, we can hire unlimited number of wealth managers, and same is with all the banks. So today, even if there are 50,000 people out there who are ready to be wealth managers, they will get a job. But for that, you need to have a basic knowledge. Because at the end of the day, so either you do a CFP program, or we have at Bajaj Capital partnered with International College of Financial Planning. We have come up with a program called International Diploma in Wealth Management, which is a 3-month program with a 3-month internship. But after that, you get a guaranteed job at a very, very good package with Bajaj Capital. So this is for the new people who want to get into wealth management. Please look up IDWM, and I will tell my team if they can open the, put the QR code for people to find out more for themselves and their children. And Hari, but so the people who want to get into the fund management industry, ठीक है, so how do they go about doing that? So what is the route you will say if a person wants to be in fund management?
So I think for getting to fund management industry, the first thing is you should be truly passionate about, as I said, the process of understanding companies in terms of learning more about the fundamentals of how companies work. So I think your love for numbers should be there, but beyond that, understanding business strategy is critical. And today, I think there was a period, maybe 10, 15 years ago, when the fund management industry was pretty closed in a sense that you would not be able to get access to companies. The annual reports also were very, very sparse on information. And you didn't have company calls, you didn't have much access to data. I think it was a lot harder for an outsider to analyze a company and make their own judgment call. Today, I believe that actually, even if you're not in the fund management industry, if I put it that way, if you are passionate about analyzing stocks, the amount of data is almost as much as that any of the large institutions have. You can access company calls, you can access company transcripts. The company presentations are highly informative today. You can get out a call and ask management questions. So if you really are passionate about it, on understanding companies, picking stocks, I think today is as good a day as it's ever been for the person who is outside the industry and still wants to pick stocks.
So Hari, I know we are over time. Uh, there is, one question: Navi AMC and Navi FinServ. What's the difference? But just some maybe answer that question, and some last words from you for the people who have joined us today. And thank you everyone for taking out time to be with us, and just sharing, a point. Hari, we have more than 25,000 live users with us.
Wow.
We live viewers with us today. So thank you, everyone. It's a phenomenal response. Heartfelt thanks to everyone. So Hari, last question: that
Yes.
what's the difference between Navi AMC, FinServ, and what
Yeah.
is your last message to the people who are watching this show?
So Navi AMC and Navi FinServ are both part of the Navi group. So Navi FinServ is more on the lending side. We have a lending arm as well, and the Navi AMC is the asset management side. So I think that's a simple answer of it. Both are part of the Navi group. And yes, thank you for all the viewers. To all the viewers, we hope that you found it very informative and it's useful to you and it's been worth your time.
Yeah. So thank you everyone for joining us today, and we hope that we were able to add value. Summarizing, this is the time to be in large caps. You must keep your portfolio because it's a very volatile market. If you want to take advantage of the opportunity, then flexi caps, and then balance advantage. So these are three segments where I'm telling you very broadly, because obviously, see, everybody has a different risk profile, different need, different term. So you have to go be very specific. Have a good advisor, be with a good company, and create wealth. Stop being out there. Be in the markets. Be with the right people. And if you look at the losses which have happened recently, it's been mostly on the direct side. So please be careful. Have an advisor. Someone to guide you. Be there with you. They have. If the person is good and he's done CFA, CFP, that shows his commitment, that this person has invested in himself to be your advisor. So there's a huge opportunity, and please follow that 15-15-15 rule and be a crorepati or a 10 crorepati or a 100 crorepati. So wishing you all the best. Thank you for being with us today.